House prices are falling at their fastest rate since 2009, with average house prices 5% or £15,000 lower than last year. Now, while some property experts are hoping for a soft landing, the market still has to absorb more bad news for the housing market. There's been a record fall in mortgage approvals, and the impact of higher interest rates will make buying less affordable for the foreseeable future. Adjusted for inflation, house prices have dropped 12% in 18 months. And while some house price indexes like the ONS are yet to show big falls, it's worth bearing in mind these have time lags between house prices sold and appearing in the data. If we look at forward indicators, such as the price expectations of, say, surveyors, this shows growing pessimism with regard to house prices, as homeowners reluctantly consider reducing asking prices. Zoopla are reporting a significant fall in demand, and this fall is particularly acute amongst mortgage buyers. Currently, it is cash buyers that are propping up the market, with cash buyers rising 2%, whilst other buyers dry up. Particularly acute is the decline in buy-to-let investors, who of course are particularly affected by higher interest rates, falling prices, and also government legislation and tax changes next year. This is causing quite a few to leave the market, increasing supply and pushing down general prices. Since the start of 2022, the effective mortgage rate for new lenders has effectively doubled, fundamentally altering the dynamic of the market. The rise in interest rates has created a real shock for a market which has got used to 15 years of near zero interest rates. As a share of income, mortgage payments are rising to levels last seen in 2007, the last crash. And given the record levels of unaffordability we saw in 2022, it's hardly surprising that a doubling of mortgage rates are hitting demand for buying a house so hard. Now, at the moment, the biggest impact on the housing market is in reducing transactions. Property sales up to August 23 were around 340,000 lower than the previous year, and overall around 23% lower than 2021. If there's one thing that's stopping bigger falls, it's a relatively low volume of new houses being put on the market, but this could change in 2024. Now, it's interesting to look at global house prices because countries around the world have seen the same kind of effect of higher interest rates, very weak economies. Yet the impact has been quite different. In New Zealand, higher rates have caused the property bubble to pop, prices falling 15%. Yet the United States, which has seen quite a significant rise in interest rates and higher mortgage payments as a share of income, prices have actually risen very marginally this year. The Economist attributes this to the prevalence of 30-year fixed mortgage deals backed by the government. This means that those who have this 30-year mortgage have no incentive to move. They're hanging on to their great mortgage deal and they can't afford to put the property on the market and sell. So in the US, there's been a sharp fall in demand for buying a house, but equally a sharp fall in the number of new houses on the market. This is why prices have kind of stagnated and even risen a little bit against a backdrop of high rents and perhaps stronger than expected economy. Because the recipe for a big drop in prices is when we have falling demand but also rising supply. Now at the moment the UK doesn't have a glut of houses like say Spain or Ireland did in 2007, but at the same time home builders are still complaining about the difficulty of selling new houses, and if this continues they'll be forced to cut asking prices. And also, if arrears start to rise or there's a rise in unemployment next year, then the higher interest rates will force more people to sell. The UK is also very different to the US in that there are very few 30-year mortgages. Most homeowners are on short-term mortgage deals, and this means that many homeowners still have to remortgage to the higher rates. Now, what could stop the fall in house prices? Some might point to the recent cuts in mortgage rates by the big lenders. Since the mortgage panic earlier in the year, rates have come down since their peak in July, and this will help potential buyers. But it's misleading to think of mortgage rate cuts, because even with these declines, they're still over double the rate of a couple of years ago. The bigger picture is that rates have gone up a lot, slightly less damaging than a few months ago, but there's still millions of homeowners who face remortgaging to higher rates in the near future. 200,000 homeowners will be remortgaging in January 2024 alone, and as more face higher interest rates, it'll be another drag on the economy and may force a small minority to sell. Now, when looking at house prices, it's always worth thinking about what's happening in the rented sector, which is the main alternative. And a shortage of properties, combined with a sharp rise in demand for renting, has pushed up rental prices really quite high. And many people in the rented sector are kind of desperate to escape and be able to buy. But the desire to leave the rented sector is very different to the ability to be able to do that. Zoopla report that because of the higher mortgage rates, the cost of buying a house is more expensive than renting for the first time in 13 years. So rising rents alone are not enough to prevent house price falls. Falling house prices deeply affects the British psyche. It's guaranteed to make front page news and is often seen, perhaps wrongly, as a barometer for economic welfare and economic finances of a country. In the past few years, the market was helped, or you could say wrongly inflated, by things like a stamp duty holiday, Help to Buy, quantitative easing, funding for lending. All these things helping to boost a demand, contributing to quite a lot of the past house price rises, especially during the COVID era. But now that's all been withdrawn, and that's negatively affecting the market because we've lost those people who were Help to Buy. Home builders in particular have been bemoaning the loss of Help to Buy. The problem is that these interventions were expensive and generally wasteful. And why should the government prop up house prices to try to maintain historically high levels of unaffordability? In fact, in the long term, there are quite a few benefits to house prices coming down. It will improve to some extent wealth equality in the UK. Now, anything is possible in election year, but it's going to be very difficult, if not impossible, to kind of buck the market pressures through expensive and wasteful intervention, especially when renters are facing even more financial pressures themselves. Now, the pressure on demand for housing is not coming just from interest rates, but also a weak economy and cost of living pressures. Record inflation and falling real wages have eaten into COVID-era savings, made it more difficult to save up for a deposit, and putting people off buying a house. And unfortunately, there's little good news on this horizon. The UK is still to face the full effect of the past 14 interest rate rises. There can be a time lag of up to 18 months, so well into 2024, the economy will be slowed by previous rate rises. And if you look at recent data, such as the Purchase Manager Index, this all points towards a decline in economic activity. Now, one key thing that would stop house prices falling is a sharp drop in inflation and core inflation, which would enable the Bank of England to cut interest rates. Now, whilst a slowing economy will eventually bring inflation down, there's definitely less optimism on inflation than, say, at the start of the year. Core inflation has been more persistent than expected, and oil prices have recently risen again. And this increased risk of geopolitical and climate-related shocks that means that decades of ultra-low interest rates and ultra-low inflation are perhaps less likely, because these cost-push shocks we saw like in 2022 could easily be repeated. And this really makes it difficult for central bankers because they face this unwelcome trade-off of high inflation and low growth at the same time. But after missing the inflation in 2022, the Bank of England is keen to restore its credibility, and there's a willingness to stick with much higher interest rates, even if it causes a significant cost to the economy and the housing market in particular. I'm not particularly enamoured of their approach, but it's likely that they will stick to it. And because less people live in a house with a mortgage than in the past, it means that to reduce inflation, there will be a bigger impact on mortgage holders than in the past. Now, one way to deal with rising mortgage rates is to extend your mortgage term. And in recent years, there has been a significant growth in the average mortgage terms, with banks almost encouraging it. But there's a limit to how much this can deal with the issues facing the housing market. For example, the number of first-time buyer mortgages over 30 years has risen from 20% in 2007 to 55% in 2022. But this rise has dropped off in recent months. If you're 40 and you're contemplating a 30-year mortgage, this means you'll be paying even when you're 70. And of course, the overall cost will be much higher, eating into your ability to save for a pension, for example. Now, the one good piece of news for the UK housing market is that unlike 1992 and 2007, Many existing homeowners will stress test at higher mortgage rates. This means that banks only lent if they felt they could cope with higher interest rates. Now the gap between the actual interest rate and the stress tested rate is falling, but we don't see the same degree of reckless mortgage lending such as in the build-up to the credit crunch. However, it is worth bearing in mind that in 2008, interest rates were cut to 0.5%, reducing the impact of the last housing crash, and this is unlikely this time around. Arrears are much lower than in the 1990s, but even a small rise would have a big effect. Another element of optimism is that last month the UK saw a very strong growth in nominal wage growth, and for the first time in months, wage growth was actually higher than inflation. This increases, in theory, nominal buying power of potential home buyers, and this will limit the fall in nominal house prices. However, this rise in wages is not sufficient to counter the impact of higher interest rates. And also, despite some nominal wage rises, workers are really not feeling better off because they've endured so much reduction in real wages in recent years. Now, predictions for house prices vary enormously, from modest falls all the way to big drops of 35% from peak to trough. And this reflects the difficulty of predicting the future, especially when so many things like inflation and interest rates are hard to pin down for 12-24 months ahead. However, overall, the factors that have caused this initial house price fall still have some way to go. Although the UK economy defied predictions of recession this year, there's still an accumulation of negative pressures, which is going to make it difficult in 2024. The housing market is a little bit like a heavy ship, which is slow to change course. But once you change course, it will take time before you see the full effect. So the impact of higher interest rates will be increasingly felt in the coming months. So there's realistic prospects of continued falls in prices. The only light at the end of the tunnel really is that there's little in the way of future interest rate rises to come. And if we did sink into deflation at the end of 2024, as the Bank of England predict, interest rates would start to fall. But by then the housing market will already look quite different to now.